what you do in order to achieve this is you collect stocks in your portfolio that are fairly conservative, meaning they have very stable income, a proven record, a proven history of stable earnings. Yeah, so every quarter they have earnings that don't deviate that much from the previous one. And stable earnings means, of course, stable prices, means stable dividends. Everything derives from stable earnings. So the way to invest more conservatively is to choose earning stable US stocks. And I put together what I mean with that, examples. These are very boring companies, I call them boring companies. Yeah? You know, Johnson & Johnson, Procter & Gamble, McDonald's, Walmart, like a clockwork, they produce every quarter very stable income. And that's what we want, because these investments will then not be as volatile as the overall market. Realty Income, I just see here, this is one of the local companies. They have their shareholder meeting next Tuesday in Del Mar. It's a real estate company and they pay dividends monthly even. So this is sort of an example. This is by no way a recommendation to buy these stocks, but if you look for earning stable companies, this is sort of a universe that you might start with. Now, it's a little bit unfair to compare all these different companies against each other because they work in different sectors. They are the utility companies, Consolidated Edison, Aqua, America. They are even more boring. They are utility companies. I mean, they are stable, nearly by definition. Everybody needs electricity and water. So their earnings will be fairly stable in comparison to Apple or IBM. So you cannot compare these directly. So the way to achieve a stable portfolio is not to put all your money into utility companies like Southern Company or Aqua America. Then you would be far too narrow. You have to diversify still. You have to cover your investment. You have to cover different sectors in your investments because you don't know which sector is blowing up next or which one is outperforming the other. The energy sector lost a lot recently, of course, yeah? Chevron, Schlumberger, Exxon. But do we know how the energy sector will do in the next half a year? We don't know. We have to spread our investments and spread our risk across different sectors. So conservative, and the next thing is you have to stay diversified. That means you have to put your money, buy stocks, ideally out of all of these sectors. Utilities, energy, financial, communication. You put your money into ideally all of these sectors. Spread them as good as possible. The simplest way is to put equal money in each sector. You put the same money in utilities, same money in energy, and then you are nicely covered. What would be even better is that you don't put the same money in each sector, but you allocate your money in such a way that you have the same risk in every sector. Yeah, the same risk, not the same money. And that means utility companies are super boring, super stable, nothing much to worry about. So you could put more money in it. Here in this example, this portfolio has 20% of its funds in utilities. Whereas the sector that is more risky, energy, receives less money. Yeah, it's nearly a third, yeah? So 3 times more money in utilities than in energy. A very good example is consumer cyclical and consumer non-cyclical. Consumer cyclical, of course, is far more risky. By definition, it's cyclical. And then non-cyclical. So you put, you double the money in non-cyclical than in cyclical. So this is an example how to spread your risk evenly across all sectors.
Yeah, is that called balanced, like a mutual fund? I was thinking, like, if somebody looked at this and said, well, that's how would I go about doing that without having, if I could just do a mutual fund based on that?
Yeah, we come to that. We come to alternatives in a minute. Yeah, there are some advantages doing it yourself than buying a mutual fund or ETF. We come to that in a minute. But here, just the idea of equally risk. You have to be a little bit, you have to know something about statistics, and you have to apply some mathematical formulas in order to make it equally risk-based. But putting your money, equal money in each sector is good enough. Yeah. So the important thing is that you cover all sectors ideally. You have to diversify. So let's summarize the conservative part. What you will do is you analyze the earnings history of various stocks. You download them from internet pages that I mentioned, that I will show you later, and you just look at the earnings history of different stocks. You pick the ones that are most stable. Yeah? You don't pick the best stock or, the only criteria is most stable, stability. And then you please select stocks from different sectors so that you stay broadly diversified. No point only buying one sector. If you buy only technology, that's not broadly diversified. And you weight each sector by putting the same money into each sector, ideally risk equal, but that might be too much to ask for. Okay, let's come to the next section, cost efficiency. Now we come to answer your question. If you don't want to do all this, if you don't want to analyze a stock's earnings, if you don't want to